And I want to start off on volatility first and foremost, because that's the new thing that's been introduced to the markets in 2018. In fact, in 2017, the biggest drawdown that we saw throughout the course of the year was 3%. And we've already had two 10% corrections this year alone. So a key question, is volatility returning back to the markets for good? Scott, did you want to weigh in on whether or not volatility is back for the rest of this cycle?
Sure. I think it's important to put this in historical context. You mentioned that last year there was one 3% drawdown. By historical standards, that's extremely rare. As a matter of fact, since we entered a period of ultra-low rates after the Fed took rates essentially to zero, we've been in an extended period of time, essentially since 2008, of low volatility. The effect of very low interest rates, the effect of a reduction in the term premium in bonds has had the effect of muting volatility across the spectrum. And equities have seen very few drawdowns over the last 10 years. So we've been in a period of abnormal volatility. I think we're returning back towards more normal volatility as interest rates start to rise, as the Fed comes out of this period of ultra low interest rates or near zero interest rates. And so I think, yes, investors should expect volatility to climb from here. But I think it's only going back to a period of normal. The problem is we've been in a period where it's been so abnormally low that it feels like it's something more than it actually is. Now, as a portfolio manager, volatility, I think, is a good thing. It actually doesn't bother me. Volatility from a portfolio management standpoint gives you the opportunity to add, subtract, to do things in a portfolio that you think adds value for a client over time. Every portfolio management team generally works on what we call a secondary buy list, a list of stocks that they hope to buy someday. They've done the work, but maybe the valuations aren't what they want. A lot of times in these drawdowns, you have the opportunity to add a stock that comes down because the market as a whole comes down. It comes down for liquidity reasons, not particularly company-specific reasons. And that's when you go to your secondary buy list and you're able to add something.
So most investors are scared of volatility, but it's an asset for an active manager.
I thrive on volatility. I love volatility.
I do think that there's a natural limit to how long these trade talks will continue. If you think about Donald Trump and his re-election bid in 2020, I'm sure he's willing to accept a little bit of market volatility, maybe some economic weakness to the middle part of 2019. But as we move closer and closer to 2020, I would imagine that the risk reward or the upside downside of a trade deal actually comes a lot more in favor of having one rather than not. But if trade wars continue to escalate, it's going to hurt the earnings picture. And we've had very robust earnings here in the U.S. because of tax cuts. But with tax cuts waning, is that going to weigh on the earnings picture in 2019? What's really going to drive growth and cash flow?
It's interesting. If you look at the effect of the U.S. tax cuts and also the repatriation that happened and continues to happen, it's very consistent with what we saw in 2003 and then a couple of years later with the repatriation, meaning that in both cases they were front-loaded tax cuts where the benefits accrued both to individuals and corporations pretty immediately, and it lowered the cost of capital in different ways, but still had the effect of lowering the cost of capital. You saw a 6 to 8 quarter benefit, and then you saw growth revert back down to what it was pre-tax cuts. That's exactly what we're seeing here. And so you got a bump up last year. S&P profits were up mid-20s, 23, 24, 25%. You now have growth reverting back more to where it was. We've got some trade issues, which I think is probably depressing growth a little bit more than otherwise. We talked about some of the effects of that on CapEx and spending. And so you have overall S&P profit growth probably coming in right now, consensus at 7 or 8%. The question is going to be, is that 7 or 8% kind of revert down to 4 or 5% or lower? It'll still be decent growth. Don't forget, the 100-year average of S&P growth is what, 5 or 6%, something around that number. So it'll still be good growth. It's the fact that we're coming off such a high level and the second derivative, or the rate of growth, is declining, that generally markets kind of struggle with until they kind of feel comfortable with that rate. What will be key this year is with a lower tax rate, what's the ability of companies to supplement that growth either with strong capital management, it could be share buybacks, it could be dividend increases, M&A, which has continued to pick up and I think will be a important theme during 2019.
Any thoughts? Any sector that you think's attractive right now?
You know, I see opportunities across sectors. I think what's happened is that you actually hear, which I find amazing, talk about recession now. And a lot of cyclical companies have actually sold off as if we're going into a recession. But yet when you look at the economic data, it's not there. There's no support for that argument, I would argue. Slower growth, yes. A recession, no. But yet again, a lot of the cyclical companies have sold off as if we're going into recession. And those valuations on the more value-oriented sectors reflect that. So I think that we're just going back to that, you know, a 4.2% peak GDP back to, you know, 2 to 3%. And those companies which have been oversold on the downside in sectors like industrials, in sectors like financials, I think that again, you can go through sector by sector, but there's a number of opportunities.
But one of the reasons why I think Europe and international markets could turn around is because of liquidity, right? Central banks still have their foot on the accelerator abroad. And Scott, this is a topic that you speak about quite a bit. So can you talk a little bit about liquidity? What is it, and where are we in the liquidity cycle?
Right, so liquidity is defined in many different ways. And I believe very strongly, studying financial markets, that kind of liquidity is the key to bull and bear markets. And that when liquidity is ample, in fact, that creates an enormous ability for asset prices to rise. It creates kind of the antecedent conditions or the background conditions for assets to rise. And then when liquidity starts to tighten, it creates a much more difficult environment for all asset categories. And essentially, that too tight liquidity results in a slowing of growth, basically, ultimately bear markets and recessions, or recessions and then bear markets. Bear markets obviously being a reflection of that recession. And so liquidity to me is incredibly important to monitor. More so, I would argue, than earnings, because earnings, again, I would argue in this evolution, is earnings are kind of driven by the liquidity environment. And so liquidity is not just the Fed. Liquidity is clearly, I mean, the Fed is a key component of that. The Fed funds rate is a key component of that. But liquidity is a company's ability and access to capital. And that can be monitored through looking at spreads. Now, we have charts that look at high yield spreads relative to the 10-year Treasury. We could look at the BBB relative to, again, the 10-year Treasury. There are lots of ways in terms of spreads. You could swap spreads to look at basically how cheap is money and what's the cost of money and how available is it. Liquidity can also be the U.S. dollar. If the U.S. dollar is higher, right, because so many goods around the world are priced in U.S. dollars, that's actually a high cost. And when the dollar's coming down, that provides more ample, and when it's up, that kind of becomes a headwind, again, because raw materials and energy, oil, is priced in dollars around the world.
And there's $11 trillion in U.S. dollar denominated debt outside of our borders, so if the dollar's strengthening, servicing that debt gets a lot harder.
Right, so the dollar plays a part in liquidity, energy or oil plays a part in liquidity, raw materials do, spreads do, the Fed funds do, all these things kind of paint to whether the picture is easy or tight. So I think that that's the one variable as we go forward over the next, 6 to 18 months that we really need to focus in on. I'll give you another example of liquidity, which is the Fed. The Fed is actually starting to contract its balance sheet. So that's a slight negative in terms of liquidity. So when you look at the liquidity picture now, I would argue that it is tighter than it's been. We had, as we talked about, ample liquidity. We're coming out of that period of kind of easy, free, costless money, and we're going into a more normal environment. That is a tightening of liquidity by itself. So you've come off an extreme back towards a normal. It's not yet a worry, but it's something to watch, because ultimately liquidity, again, I would argue, is the prime determinant of both bull and bear markets.
Well, I think we're up on time. I appreciate you all joining me in the studio here today, but I want to just leave the viewers with one key takeaway. If there's one thing that you want the viewers to think about what's likely to transpire or keep in front of their mind for 2019, what is it?
I would focus on in the portfolios. I think that I'd agree, we're in the later stages. Per your comments, it doesn't mean that can extend for several more years. I don't think there are any signs of a recession. Slower growth, yes, but a recession, no. I think liquidity is something, as I mentioned, we need to continue to watch. But I think it's fine right now. And in fact, as you heard, global liquidity is actually is either expansive or becoming, in the case of China, more expansive, and that's helpful as well. When I think about stocks and I think about the portfolio, I think that we are in the stage where there are certain periods of time where quality-oriented stocks do better and quality-oriented stocks do less well. I think we're in that former stage where quality, as you come towards the later stage, when you've got these issues, when you've got more volatility, I think there is a preference for quality. And so my message to investors is stay diversified, as Margaret said, but also kind of lean towards that quality-oriented portfolio. It's not the time, per se, to have the pedal to the metal. It's not 2003, it's not 2009, where things are cheap across the board and everything's going up. I think there's much more separation between the good and the bad and those that are actually performing and not. And so everything doesn't go up per se. The market will go up, but everything doesn't go up per se, and that I would be leaning towards consistency of ROEs, consistency of balance sheet. So I think quality of balance sheet as we get in the later stages matters more. We've seen that more recently with the correction, and quality overall. So my comment would be lean towards quality in terms of your both stock and portfolio selections.